What's up, guys? Sean from Invest to Live here, and today we are going to be talking about a couple of the options that I'm leveraging in and around Palantir, both from a stock perspective as well as a long-term strategy around how I hold it within my portfolio and how I protect myself, especially during times of risk like we're seeing right now. So what I did a little bit different than normal is I created a little bit of a PowerPoint presentation. I'm not a huge fan, but I want to use this as sort of a baseline to understand what we're going to talk about today. We're going to talk about three strategies that I think make for a good fit with Palantir. But before we do this, I want to really be clear on a disclosure today. Number one, first and foremost, I own Palantir stock, I own long-term options, and I take multiple hedging strategies within that ownership. Now, sharing this because I want it to be very clear that I'm already an owner of Palantir at scale in a number of different ways. Now, additionally to that, I also want to be really clear that I am not a financial advisor. I'm not your financial advisor. This is not financial advice. This is just education on the way that I approach this, the way that I use different kinds of techniques within my portfolio. And for sure, these techniques can be very costly and very disruptive to your portfolio. You can lose a lot more money than you put in oftentimes. So you have to make sure that you're not leveraging these things in your own portfolio unless you are a trained and knowledgeable expert in this field. Or at the very least, make sure you're doing a lot of time and a lot of research with your own investments to make sure that you're doing things the right way for yourself. I always want to say this. Buy and hold is the best strategy for almost everyone, right? We know that. But you're probably not watching this because you're looking to just be a buy and hold. So I really want to urge you, do your own research, learn the right way to do things like advanced techniques and strategies. And if you're going to implement them, know all the risk that's associated with it. So with that, I'm going to share my screen and I'm going to jump right on in here. Excuse me. Okay. So let's kick this off. Right, I was thinking about this weekend. We got buried in about 2 feet of snow. It's 10 degrees out, and I was outside shoveling, thinking how sometimes you just can't do anything about the fact that you get 2 feet of snow. You have to go out and deal with it. And you deal with it by making sure you've got shovels and you've got some salt to melt the ice. And, maybe you turn the heat up a little bit or whatever you do, right? You want to make sure you've got the right things in place to protect yourself. This way you can still take advantage of the situation, still get to work, do what you have to do. I was thinking about with Peloton, we're coming off of Palantir, rather. We're coming off of a really tough scenario here where we've just watched the price come down from all-time highs to hit really new lows. But this doesn't mean there's nothing you can do. There's no strategy for recouping or for getting back in here or holding long-term or taking advantage of price action when and if it does change. So that's really the premise of what we're looking at today. So again, let's jump in. 3 key techniques that I'm leveraging at scale within Palantir as a holding in my portfolio. We're going to be talking about long and short hedging, and then I'm going to actually talk about how I play this differently than the way a hedge fund plays it. I talk about married puts, and we're going to talk about leaps. All things that will be explained as easy as possible because I don't think making it complex helps anything here. Now, first and foremost, we're going to talk about long-short hedging techniques, and then also why I don't recommend this, and I do it in a different way that I think is much easier for a normal retail trader who has an understanding of options markets at scale. So long-short hedge is when I look at 2 companies, could be Coke and Pepsi, could be MasterCard and Visa, maybe it's Palantir and C3 AI. And what I like to do is find players who are very similar in very similar sectors or segments where one I believe is going to be better than another, or one has a chance of even going down further than where it is today. So the idea behind a long-short is you're betting on one going high and you're shorting the shares of the other. And typically you're taking a ratio of 130% long to 30% short. Now, I want to be really clear here. If you heard those numbers and it's confusing, it's for a good reason. The real play here is that you're leveraging margin at scale, typically, to do these kinds of plays. Now, I don't suggest any retail trader leverages margin. That's why I think there's a better way to do this, but I still want to explain the process here and then why I come up with this other idea. So I look at Palantir. I believe they've got a great product. They're expanding heavily into commercial. They've got very diverse holders of the stock. They've got a strong management team that's growing. Their sales team is expanding, their operations team is expanding, and just basically looking at the demos of the product and the way it works. It's something I feel like they have a comfortable moat on, plus they have a good amount of long-term contracts in pipeline, in backlog, and with the government. So it's guaranteed money, as guaranteed as money can be. Now, the reason this makes sense is I think that Palantir long-term is very likely to go up in price. Again, this is just my opinion, certainly not an analyst by any stretch of the word. So I want to make sure I'm in a position to see a gain here if Palantir does go up. But perhaps I think that C3 has a little bit more of an issue growing the way that Palantir might. We know that their founder has sold tons of his own shares. We know that one of their largest shareholders, Baker Hughes, is also their biggest customer. So if something goes wrong there, it could be a double whammy and really pound the stock. Now, at the same time, though, we know that C3 has gotten absolutely destroyed from all-time highs to just seemingly never-ending down, down pressure on the stock price. So it's very likely that there could be further pressure here until we get to an equilibrium on a market cap perspective or a price perspective. But the problem is taking out a long short can be really difficult, especially for a retail trader who doesn't know a lot about shorting, managing the costs of that, managing the margin, the risks, and everything that goes into it. So there might be a better way to think about how I can play both sides of this. So what I do is I take a look at something like a straddle, right? In a straddle, what I'm doing is I'm looking at Palantir shares, and I'm saying to myself, do I believe that it's very likely that we could see an aggressive uptrend or an aggressive downtrend? Something that's going to move really in a big way. The way a straddle works is I'm going to pick a strike price. Let's just say the price currently today is $13 a share. And I want to pick a price of 20 because I think it's going to get back to 20, say, right? In my head, that's the movement we think is going to make. But the problem is this thing could get down to $5, right? We're seeing crazy numbers like that. So with a straddle, what I'm going to do is I'm going to buy a call and I'm going to buy a put for the same strike price, typically right at the money. So let's just say we do it for $13 today. Now you can pick all different kinds of time frames. It works just like any other option, except that you're buying two at the same time. And let's say in a year, I want to buy a 1 year option, right? So it's going to expire a year from today. And what I'm going to do is I'm going to pay the premium to buy the call, and I'm going to buy the premium to buy the put. And the most I could possibly lose on this will be the total premium of the call and the put. And my goal is to see the stock price, the price of the option really, the price of the option either go really high or go really low. And in this case, my goal is to have a net benefit of profit that is higher than the premium paid. I've been a straddle trader for many years. The key here is you have to let the hedge work. You have to give it time. You have to give that price time to grow or to contract even further. You can't rush in or rush out. But ultimately, if you have highly volatile stocks of growth companies, even when things look bad like they do today, a lot of times you can see it work out where you're going to take profit from it. Now, the downside here is you are paying a lot of premium, and that money is ultimately gone until you make it back, right? So you have to make sure you have room in a portfolio to carry this kind of premium. You have to make sure you have room for more capital to deploy to other areas. But again, the key here is if you think there's a big play here for something to go big, this is a great way to play it, especially if I'm not worried about owning shares today. I just want to get the price action profit on it. So long shorts are how hedge funds would do it. Straddles are how I do it as a retail trader investor. And I think it's a great, easy way to think about getting into options with a known risk and quite a bit of upside potential, right? So just keep that in mind as we go here, that the goal here is looking to maximize profit while minimizing my total loss, okay? Let's jump into the next piece here. The next one I want to talk about is married puts. I'm a pretty big fan of married puts, but I like to play them in different ways. Now, as the name suggests, a married put quite literally means that it's married, it's long-term, and it's married to the stock that you own in your portfolio. So in this example, let's say I own 1,000 shares of Palantir today, and I'm concerned that the price could go down even further, and I want to buy insurance against my shares in my portfolio. So this gives me the ability to protect my downside while still having the ability to profit, even though I own those shares long-term in a long position. So the way a married put would work is exactly the way your insurance works for your house, for your car, a boat, a business, whatever the case is. I'm essentially going to have a put always open against my shares to protect my downside. Now, I had some married puts in my portfolio, so when the markets crashed recently, although overall I don't love seeing my stock prices go down, I was making money all the way down as my puts became more valuable and I was able to sell the past couple of weeks. So this is what this really is if you approach this from the standpoint of I'm going to buy puts as insurance to protect the cost of my current shares. When things do crash, you'll make profits on those puts. You can take those out and, of course, buy more puts to replace them, or you can use that profit to actually lower your cost of ownership of those shares if that's what you're looking to do. That's what I do personally, but again, not financial advice, just the way I like to do it. Now, sometimes the issue with married puts is this can get very expensive over time, right? If the price is stagnant and you're constantly renewing and buying these puts, you're having to constantly pay that premium. Now, we just saw a big crash recently where the prices have gone all the way down, but who's to say if they're really stuck here or they could go down further? So it doesn't mean that it doesn't still make sense today. But one way I like to play this at times is I will sometimes buy a put against my shares around earnings, or around other companies' earnings in a similar space. So sort of like a synthetic married put, or maybe what I'll call a dating put, right? you heard it here first. And what I want to really understand is, how do I ensure that if something does go wrong, or there's a glitch in the system and this thing crashes quickly, I've got some protection. And if it goes up, great. Then I lose the premium, write that off as a loss at tax time, and all is well. Always talk to a CPA, of course. So married puts are pretty straightforward. It's a super, super easy way to use options to hedge your bets. And I want to point this out too, because I feel like a lot of folks on YouTube are not really familiar with hedging the right way. And I think they talk about hedging and hedge funds and how hedging works. And I fear they don't always understand. The value of a hedge is that it grows over time, right? So the first sign of a profit, I don't get rid of my put and take the profit. I really want to keep it there, right? Like, rock comes through my window, I want to get my window fixed, but I want to make sure I've got that insurance premium in case a fire starts in my home or a big car accident totals my car, right? I don't just want it because I got a fender bender. I want it for like a total loss. So if you're going to leverage things like married puts or dating puts, as I said, make sure you're really giving them time to come to total fruition until you see a turnaround in the market or they come towards expiration, right? And then that's the best time to think about when you're going to leverage that profit to take away from it. Now, the final thing I want to talk about here are leaps. Now, this is the really total opposite in a sense, right? With leaps, what we're looking at is long-term options. So anything over 1 year. Now, in this case, what I'm talking about is leaps from a call perspective. Now, we know that Palantir is trading way down. I think a lot of folks who watch this channel and other channels probably looking at Palantir, understand the technology, the company, the vision for it, the way they're growing. And you're probably saying to yourself, I feel like this is a company that could really go up in value, right? I don't know if it will, to be honest, but I think it will. So that's why I have it in my own portfolio. So what I do is I go out and I buy leaps. This is a strategy I use quite often in my portfolio. I've been doing this for years, and every year I've got more of them coming to fruition that I'm trying to cash out on. So leaps are really for when you're taking a long-term vision and you believe that this company has the ability to see its market cap and share price really grow over time, okay? But the big call out that I want to take here is, it's not as simple as just saying, like, I'm going to buy leaps because I want the price to go up. I have it here in my notes that it requires conviction and capital, because you have to really be confident that you're willing to tie up your capital in these calls long-term, right? You're paying premium to do this, and you have to hope in the long term you're right, or that's money that could have been spent somewhere else. So if you feel very strongly that in a certain amount of time, a year, 2 years, 3 years, whatever the case is, this price is likely to go up, leaps are a great play. I happen to like leaps just in general because of inflation, the growth of the market, and my dog obviously is barking and must be agreeing with me. I think leaps are a good, smart play for a lot of portfolios, because over time we know the markets typically do grow, and it's a good way to play shares without owning shares necessarily, but get all of that upside from the options perspective. That's why I use them. The only big consideration really is, are you missing other opportunities by taking long-term positions here and spending that premium to get these leaps, right? Something to always consider. And then also from a cost consideration perspective, because you're buying this option so far out in the future, they're typically going to cost a little bit more. So you have to consider that as well, that maybe a 6-month or a 12-month leap might be a better a 6 or 12-month call might be a better play for you personally than something going this far out into the future. But again, I said this at the very beginning of this video, and I want to say it again. I do hold leaps in Palantir. I absolutely don't recommend anyone do that. But for my strategy and the way that I invest, it makes sense for me. So I just want to wrap it up there, right? Number one, I appreciate you watching. I covered 3 techniques: long and short hedging strategy, but being replaced with straddles. We talked about married puts as an insurance policy against loss of your value of your shares. Excuse me. We talked about leaps, long-term options for looking at long-term price movements. What I would really ask you guys, I never say this at the beginning of videos. My kids tell me I should be, but if you haven't liked or subscribed, we'd really appreciate if you do that. It helps the channel a big time. And if there's techniques that you're using that I'm not talking about, or you think that should be explained, or you'd like to learn more about, throw it below in the comments. We'd love to hear it and hear how you're doing things, or hear other questions you might have about it. So with that, thanks so much for watching. My dog in the background obviously got excited about hearing those leaps that I was talking about. And with that, I hope everyone's safe out there. You're doing good. And as always, spend time being and getting educated in this space. Know the ways you can play it, know how it affects your portfolio, know how to protect your risk. But understand, hedging takes time. Don't jump in and out of positions based on fear. get into things with conviction, know your entries, know your exits, and leverage insurance when you can to really protect yourself. So with that, thanks so much for watching. Hope everyone has a great day. And if it snowed where you are too, good luck with the shoveling and keep your back safe. See you, everybody.